Welcome to the deep dive video update. And I always want to explain what this video is about if you're watching this for the first time. Every week, I look at hundreds and hundreds of charts about the S&P 500, other markets, other indexes, and I pick out those charts that are really speaking to us right now. Well, there's a number of charts that I skip. And so what this video is, are the charts that I really didn't talk about all that much, that are not really speaking to us all that loudly right now. And I put them together in this video. I also have some additional charts in this video that are only in this video because we have to look deeper into these charts to see if they're telling us something useful. This is being prepared for Monday, August 19th. I do have a thing called the SPX Investing Program. It's free for right now. If you want to learn more about that, there's a link in this description below this video that'll take you to the website or take you to a playlist on YouTube that'll talk more about the program. Also, this is just one of many videos that I do each week. You can see down here, deep dive, that's this video right here. I do a number of different weekly videos, but they all tie into the daily video. That's the real foundation of the analysis and commentary that I do, because I found that's been the most effective way of analyzing the market over the decades that I've been doing this. The first chart that you see is the VIX. You don't see it because it's invisible. Over top of the VIX is a 50-period exponential moving average. And this goes all the way back to 2004. We don't use this to make decisions. This is more for information, and this chart is unique just to this video, where we want to see what is the general range of the VIX. Now, when we saw that big decline on August 5th, there were people that were posting about the VIX, posting pictures. They had no clue what the VIX even is, but they started to hear about it as the stock market was at the forefront of the pop news for a day or two. Well, this just tells us what is the range of the VIX over a period of time. When the market's really going down, the VIX goes into a higher range. When the market's going up, the VIX goes into a lower range. Well, back in 2020, after the COVID crash, and then we went into 2022, we were in a higher range with the VIX. Well, since we've been going up after hitting the lows in October of 2022, the VIX has dropped down into a lower range. Now, the decline that we've seen and the massive readings that we were getting from the VIX, yeah, that can affect this. So this is starting to go back up, but we don't see lines going straight up or straight down with this particular moving average. But overall, we still continue to be in a lower range. Even though we got above this chart anyway, we got up to like 65 with the VIX. Now we're back down into the 15 range or so, even a little bit below 15 on the daily charts. We also measure the speed of the VIX, and I use an RSI based on 9 periods, a momentum oscillator, to help to determine is the VIX going up or down really fast. When we see a really high reading, like we saw here, that means the VIX was going up really fast. Now, the VIX goes in the opposite direction of stocks. So if the VIX is going up, that means fear is increasing, and stocks are usually dropping at that point. Well, since that time, as the VIX has been coming back down below 15, we're seeing the momentum of the VIX really dropping off as well, but not in an extreme reading right now. Then we look at another thing called the VIX of the VIX. This is like a VIX on top of the VIX, and it's called the VVIX. And we do a ratio between the VIX and the VVIX, and it was gyrating all over the place. Well, typically when this is going down, that tends to be more positive for the market. This had been going up, but as the VIX has really been dropping lately, we're starting to see this ratio go back down, which is positive usually for the VIX, and also positive for stocks. Okay, then we have another variation of the VIX called the skew index. When they calculate the VIX, they use at the money options, whatever those are at that time. Well, the skew index looks at out of the money options, either above or below current price. And it also generates its own readings that we get. Typically, when we get up into this red area, that means the market is expecting some kind of a big move. but we don't really know if that's going to be to the upside or the downside, or if it's even a non-event at that point. We have to use this chart in conjunction with other charts to get some better context. Well, we came up into this red area, and then we saw some real problems after that. Right now, we're below the red area, so I haven't been showing this, but we're seeing more uniformity across the board with all our different fear gauge and sentiment indicators that we use, that fear is really starting to drop right now. But this chart just isn't giving us any additional insight at the present time. Very similar to that is a correlation between the VIX and the S&P 500. The VIX is correlated on the S&P 500, and that's one of the benefits of just looking at the index itself. Well, when this gets above this dashed line, that means the market's getting pretty nervous. That means fear is pretty high. We were seeing it in this study right here, but we were not seeing it necessarily in other studies at that time. When we get above this dashed line, that's when I start showing this video. Since the VIX has really been dropping and the S&P has been going back up, we're starting to see this correlation actually go down. Then, just to keep an informational perspective on where are we in relation to the previous all-time high that was set in January 2022, we are up 15.27% from the high set in January 2022 here. We had fallen back into single digits, but as the market's been going back up lately, we're getting back into double digits again. And then stockcharts.com has this thing called technical alerts. And I go through these every day in the daily video. But what you see right here, this is for the whole week. And if it's blue or green, depending on what color you see, that's positive. And if it's red, that's negative. Well, throughout the whole week, you can see there's a whole lot of positive signals that were generated all the way from Monday to the concluding one on Friday, where gold went above 2,500 for the first time. Well, Canada had a little bit of trouble on Friday, and then the NASDAQ was bouncing around a little bit earlier in the week. But you can see that a lot of positive signals were generated throughout the week. So this is more just a big picture look at, are we seeing mostly blue or green, or are we seeing mostly red? A couple of weeks ago, we were seeing an awful lot of red. Now we're switching back and seeing more positive colors here, and that just gives us an indication that things are looking better. This looks at sectors, other indexes. It looks for technical analysis events that actually occur. And so this can be quite helpful. Then another thing that stockcharts.com does is they try to remove as much emotion as possible, because even though technical analysis was created to try to remove the emotion, there's a lot of emotion that goes into it. There's a lot of subjectivity. You can have 10 different people looking at the same chart and come to 10 different conclusions, whether we're going to go up or down, and justify what they're seeing in the chart. That's why the indicators that I like are very cut and dry, black and white, yes or no, positive or negative. Well, Stock Charts tries to even take that a step further by ranking this, by removing all emotion and giving this a score of 0 to 100. The higher the score, the better looking that chart at any given time. Now, you can apply this to sectors, other indexes, to individual stocks. I use this with 5 different indexes. The S&P 500, which is the foundation of everything that I do and teach and analyze. But I also look at the NASDAQ 100, I look at the Dow, I look at the mid caps, and I look at the small caps, and then rank them. Which one's looking best right now and which one's looking worst? Well, coming in first place this week is the SPY, which is the ETF attached to the S&P 500. This one held up a bit better as we were going down because there's 503 stocks that make up this index. And so it wasn't going down as much as, let's say, the NASDAQ 100 or even the NASDAQ. Because the NASDAQ 100, you know, 100, there are fewer stocks in there. And that's really nice when things are going up. The NASDAQ 100 tends to outperform. But when we're going down, the NASDAQ 100 tends to go down faster, where the S&P was going down and turning negative. But at the same time, it was holding up a little bit better. Right now, it's coming in with a score of 86.7. When a stock or an index is really looking strong, we want that score to be 90 or above. But the fact that this is coming up after dropping down below 40 just a few weeks ago. This has been showing a real improvement. And as of Monday, August 19th, this is the best looking chart out of the 5. In second place are the QQQs, which just got hammered. We got down below 20 here. We were in the teens with this when we were really moving to the downside. And this has really made a good effort to come back. We're coming in at 81.2, looking pretty good, but still in second place and still not into that 90 range that we like to be in when it's really strong. In third place is the Dow, which also fell back, got down into the 30s. It's coming back up, and we're just under 60 at 59.7. Then we have the mid caps, which are under 50, and that's kind of the general line in the sand. Above 50 tends to be more positive, below 50 is more negative. Well, this one had fallen down too into the 30s, and it's trying to make a comeback right now, so it is showing some improvement. And unfortunately, yeah, we've been teased a lot. Not we, because I don't do small cap indexes or even small caps, but a lot of folks were putting some hope in the small caps, and for a while there, they seemed to be receiving a lot of love, and we got well up into the 90s. Back in July, this was the best performing index. Well, then things kind of shifted and looked more negative, and we started going down, and this really fell down actually to about 20. Well, it's making a good comeback, but it's still coming in last place this week at 43.1. Then we look at a short-term chart of a rainbow. These are moving averages going from 10 periods up to 50 periods, and it looks kind of cool because you change the color, people ooh and ah over that. Well, this just gives us a bigger picture look going all the way back to 2019 to see, okay, what is the short-term trend doing? When we're really going up, price is above all of these moving averages, and that shows a good, strong short-term trend. Well, we fell back. We fell quite a bit under the rainbow, but now we're starting to break out above the rainbow. And if we can keep going up, these lines will eventually smooth out and start to go back up as well, suggesting that the short-term trend is more positive. Now, that may not happen. We may run into some trouble and come back down into the rainbow. But for right now, this is looking more positive on a short-term basis. Intermediate term, another rainbow, going further out with longer moving averages from 50 periods up to 100 periods. We came down, dropped below this rainbow as well. Now this moves a little slower, so we're not seeing all the rolling over as much with the lines that we were seeing on the short-term chart, because we were able to come down and then bounce back up quickly, and we're actually above the rainbow. And the same thing is true here. The longer we can go up and stay above these lines, the more these lines will turn up and start to smooth out. Then we want to keep an eye on the distance away from the 200-day simple moving average. You notice here when you look at these green areas, especially over the last, well, in 2024 anyway, when we get up to about 15% above the 200-day simple moving average, that's when we typically top out and then see a decline. This was April when we saw a pretty significant downturn, but then we were able to bounce up out of that. Well, this time we got up about 15% above the 200-day simple moving average, and then we declined. And this was the big drop that we saw at the beginning of August. And now we've been bouncing back up. So we want to keep an eye on this. If we get back up to that 15% level, this will be a warning sign to us. It just means we're getting far away from that 200-day simple moving average. And whatever moving average it is, and I use 20, 50, and 200. I also have a 100-period moving average thrown in there too. But the 20, 50, and 200 are the real basic ones, because 20 to me is short term, 50 is intermediate term, and 200 is long term. So we'll be keeping an eye on this. If we really start to go back up, this will be a warning sign to us. All right, then this is another way of measuring things. When we go from the low set back in October 2023, not 2022, that was the low. This was just a low after we had been seeing a 10% decline. Well, we've been coming back up since that point, and we're up 26.15% from that October 2023 low. Now, when we hit a top in July, the middle of July, and then started to come down, this is one thing I was noticing. From the top all the way down to the bottom was almost 10%. That's the definition of a correction, if we fall 10%. A lot of times the smart money is sitting on the sidelines and they're watching this decline, and they say, okay, we're not ready for things to really turn negative yet. Things are still looking good with earnings. okay, people think the economy's falling apart, but we're not necessarily concluding that same thing. We think that we'll switch back over and look positive again, which is what's happening right now. And I'm just kind of making up this scenario here. So when we started to get close to that 10% level, we were also seeing intraday support, and we were seeing support all the way out in weekly charts, all coming together at about this low right here. That's when the smart money started to come in and buy. And I was watching this too. And so we have been bouncing up ever since that time. So this is another thing that we keep an eye on. It's like when we fall, how far are we going to fall? A percentage like this is a good tool to use. Now, we didn't get quite down to 10%, but we got close when we really saw that decline. And we look at the Bollinger Bands, and there's a whole book written by John Bollinger that talks about how you can use these things. The way they're used on this particular chart is we measure when they go outside of the upper or lower Bollinger Band, because this doesn't happen very often. And then from that is a thing called the percent B indicator. And when we go above this blue line, that means we're outside of the upper band. When we go down here, that means we're outside of the lower band. Right now, we're not above or below. Now, when we really went down in early August, yeah, we were down below that, and that tends to not last very long. Right now, we're looking more positive since we're above the midpoint and going up, but we're not giving or seeing an extreme reading right now. I do have a 100 period moving average that we were watching, and this was being shown in the daily videos as we were coming down to this level. We actually broke below that, and we were wondering, okay, are we going to go down and hit the 200-day moving average? Well, before we got to that point, this is where all the support started to come into play. Intraday, daily, weekly, seeing and on different indexes as well. And we saw this convergence of support coming together, and that's how we were able to bounce up out of this. So right now we're well above the 100-day or 100 period moving average. So I haven't been showing this chart for the time being. Then we look at the S&P 500 on top and then the S&P 100 on the bottom. The S&P 100 are the biggest stocks in the S&P 500. Really what we're looking for are some kind of divergences, either positive or negative, where the S&P 100 might be leading things a little higher for the S&P 500 or lagging behind, or the S&P is lagging where the S&P 100 is outperforming. We're not really seeing anything right now. For the most part, the S&P 100 has been outperforming the S&P 500. The bigger stocks are outperforming the smaller stocks. And that's what we're seeing. When this started to underperform, and I have other charts that measure this, that was giving us a little cause for concern. But now we're seeing an improvement with the S&P 100 actually leading things higher. And so this is turning more positive. But we don't see that on this chart. I use other studies to look at that. Then we have a thing called the Pring bottom fisher, developed by Martin Pring. And this tries to find a bottom when we've really been declining. The only problem with this is this signal was actually generated back in the middle of July when we were hitting highs. That's when we saw a cross above this red line. And then as we were going down, the Pring bottom fisher was going down, and we're not getting a signal right now. So this is by far, or far from perfect by any means, but sometimes it's given us some pretty good signals. Other times the signals have been completely wrong. Then looking at a long-term rainbow going from 50 periods up to 250 periods, we really haven't seen the lines shift all that much. We came down into the rainbow, and now we've been able to bounce up back out of that. And since these are longer moving averages, they take longer to move, and it really hasn't done much damage to the rainbow itself. We're turning back positive in the long term because we're above the rainbow again. And then this is a long-term oscillator that we look at. And I don't show this chart because I would just show the same thing. The last time we saw a signal was in November of 2023. So why show this chart if it's just showing us the same thing going forward? But I like to show it in this video just to give you an update. When we were going down, yeah, this was seeing some weakness, but we're still above this red line, and the red line itself is going up. And just to give you a little bit more context, the weekly chart is still negative and has been negative for, I hate to guess the actual time, but well over a year, possibly a couple years. It has not been able to turn over positive. But this chart has been positive for all of 2024. And if we continue to see the S&P go up, we will see this chart start to turn and show more improvement. Then we look at a weekly chart on top of the S&P and then the German DAX in the middle area. That's the biggest stock market in the EU. And this is a longer term chart. And we want to see, okay, what's the correlation between the two? Are European stocks and US stocks tending to correlate with each other, meaning going in the same direction at the same time? Not right now. They're actually more neutral as the S&P has been bouncing back up. Now, the German DAX has been improving, but not quite as much as the S&P, and that's why we're seeing this correlation dropping off currently. Then I do have one support and resistance line here. This is a Fibonacci retracement chart going from the all-time high back to the low set in October of 2023. As we were really screaming to the downside here, we got close to this 38.2% retracement level, but we were able to find support above this. So since we're bouncing back up now, we're in no man's land between these two fib retracement levels. There's been no need to show this chart, at least anymore. Then we look at a broad market measure where we have the VIX that measures the volatility of the S&P 500. There's another thing that you gotta love this name, VIXN, which measures the volatility of the NASDAQ 100. Now, if you're heavily involved in the NASDAQ 100, you probably look at this chart quite a bit. I don't use it all that much because I focus on the S&P 500. And when we were screaming to the downside, and I mainly look at the closing value here because these look like icicles falling off the side of a roof here. And there's a lot of erroneous data in this up here, and it makes it hard to really use here. But so I look down here, this is the closing value where we were screaming to the upside, and we've also been really falling back with the VIX in here for the NASDAQ 100 as the NASDAQ 100 has been improving. Then we look at the S&P on top, and then a ratio between the QQQs, which is the NASDAQ 100, and the Dow. And then that ratio we compare to the S&P. And this ratio is going up. That means the Qs are outperforming the Dow, even though the Dow's been doing fairly well lately, and the S&P's been doing pretty well lately. Well, we can see the correlation on the bottom is pretty strong. So whatever this ratio is doing, the S&P is probably doing that at the same time, whether it's up or down. Then we look at the transports, and this has been a real disappointing area in 2024. We want the transports to do better. If you look at previous times when the red line is above the black line, that means even though they're on different scales, they're different indexes, this is typically more positive for the market. And we've been chopping all over the place here for a while. Well, for 2024, the red line, which are the transports, they continue to underperform the Dow. This would help the market be more positive if the red line could get back above the black line here, but it just hasn't been able to do that. Look at the bank ETF, and this is one thing that's encouraging. The financial sector, which banks are part of that, the financial sector is quite positive. It dropped below its 50-day moving average, even though it's been in an uptrend when you look at it by itself, but it's been able to get back above that 50-day moving average. The bank ETF here, which is part of the financial sector, really dropped, came down close to its 50-day moving average, but really was able to stay above that and is showing some improvement here. And then we look at a ratio between regional banks. These are smaller banks like Silicon Valley Bank, Republic Bank, the banks that flopped about a year and a half ago now. And then we had New York Community Bank late in 2023, I think it was, really saying, we're having some problems here. And so we've been on regional bank watch ever since then. But so far, things have been holding up okay. They're not necessarily falling apart. We watch this area in case we see a real meltdown. Of course, you can watch videos and people will give you their opinions that the banks are going to fall apart. We watch the charts. That's how we reach our conclusions, not just some opinion that we seem to come up with, no matter how justified it may seem at the time. Well, this really dropped off. This was when things really started to show a breakdown when we look at the ratio between the regional banks and the financial sector itself. Well, then it was chopping around, looking a little bit better. This is Silicon Valley Bank and Republic Bank, and that really took this ratio lower. And then it looked like we were getting a little bit better. And then New York Community Bank comes out and this really goes down again. Well, we've been really choppy here, but we're not necessarily breaking out to the upside, but we're not falling apart right now either, even though this is still in a downtrend. The blue line is below the red line. We want to see this continue to go up. That would be more positive for the stock market as a whole, and eventually see this blue line cross back above the red line. Then some rate of change charts. I just use these for informational purposes. There are a few 200 period type studies that I use. I like the 200-day moving averages. There's a rate of change based on 200 periods that I have been showing lately in the daily video. This is even longer. This is 250 periods. And we're continuing to show a real improvement after we have been declining. This is another look at that same chart, but going back further, where this is also improving. We got up to this blue line, and this was kind of a warning sign that we were looking at here. Longer term, we bounced up above the blue line. That means maybe we're getting a little extreme. This is about the time we got about 15% above the 200-day moving average. And we've pulled back. We came down just like everything else did in early August. Now we're starting to come back up and showing some improvement. All right, then we keep an eye on bonds because there's a real strong relationship between stocks and bonds. Where on top here, we have the S&P 500 that's in red, and it's been going back up. And we look at the TLT, which is the long-term bond ETF based on price. And this has been going up as well. We're seeing an improvement here with their 50-period correlation. That just means their long-term relationship of going in the same direction at the same time is getting a little bit stronger. Their short-term relationship or correlation had really weakened as they were going in opposite directions from each other. This is also starting to show an improvement. And then I have a couple of spread studies down here, but I don't really focus on those that much. I'm mainly looking at the correlation in the short and more longer term here. We also do another correlation study between the Qs, the NASDAQ 100, and that same TLT, although here it's red, where on the other chart it was blue. And we're seeing that they're having a tendency to go in opposite directions now when we compare the two with each other. And then we have a weekly chart above, and we take the 10-year yield and we subtract the German 10-year yield because there's a correlation, there's a connection between what goes on in Europe and what goes on in the US. Well, US rates are higher than German rates, but lately this has been coming down. And we've also been seeing the US dollar index going down lately. And stocks like lower interest rates. They also like a weaker dollar. And then we look at the correlation on the bottom between the top chart and the middle chart, and we see that there's a pretty strong correlated relationship between these two. So if they still continue to decline and the correlation stays strong, this is longer term, and this could be more positive for stocks. Then we want to keep an eye on the yield curve. The one that most folks really follow is the 10-year to the 2-year yield. And we've been inverted now for over a couple of years. We're below this red line. We're getting close, but we have not been able to close back above this red line yet, meaning that we're not inverted anymore and we're going back to being regular. Now, there's some economists that also follow a 10 to 3 month. And of course, the debate goes back and forth. Which one is best? I don't know, so I look at both of them. I also have some other yield curves here that have gone back to not being inverted anymore, but they don't seem to play a real role in what's going on with the inverted yield curve. But we want to keep an eye on this because if we go back and get above the red line and able to stay above the red line, that's usually when we start a countdown going into a recession, which could happen immediately. Typically, the average is about 6 months after we go back to being uninverted or regular again. And I've seen a few videos out there on YouTube saying, yo, as soon as the yield curve gets back to normal, then that's when stocks are going to start to crash. And that may happen. But to say that and freak everybody out and have them making decisions now with something that hasn't even happened yet, I think is very irresponsible. That's why we look at these charts every day. We keep an eye on this. We've been watching it for over a couple of years now. And when it goes back, we'll watch this. I'll make note of it, and then we will adjust things based on what we see happening in other charts. Then we look at the TIPS, which are Treasury inflation protected securities, and we compare them to the 3 to 7 year bonds. Now, the reason this chart is on this video or in this video is because this one doesn't move as much as some of the other charts that we've been seeing lately. Now, this was kind of switching the scenarios recently, right at the beginning of August, and why we saw the real decline is that the employment situation report was weaker than expected, and the market all of a sudden started to freak out, thinking, uh-oh, employment, because that's been a stronger area. That's been one of the reasons why the Fed has justified keeping rates higher for longer, is that employment has been hanging in there pretty well. Well, when the employment situation report came out, the market freaked, and then we really started to decline for different reasons. The context was changing. Well, now we're seeing that weekly jobless claims are looking better. It looks like the economy's not necessarily falling off a cliff. And so now we're switching back more to the positive type of scenario, where if we keep that scenario going and this continues to fall, that will be more positive for interest rates. This tends to go up when folks are worried about inflation and interest rates. This tends to go down when they're not as worried about inflation and interest rates are usually falling. But we have to look at the context. Why is this going up? Why is it going down? This had been going down, which was positive. Then it switched over to negative. Now it's trying to switch back and look more positive again. And then I have a thing called the possible positive scenarios. And I really hauled these charts out back in 2022 when we were going down with a vengeance. Well, I have a number of charts. I don't actually know the number, maybe 8 or 10 charts. And some of those I still use every day in the daily videos. But there's a number of charts that I don't use all that much. And that's what I show in this video, where we look at this first one, and I have a different study that does the same thing, but I use this in a different context in that other chart. These are the percent of S&P 500 stocks that are above their 200-day simple moving average. When we're above 50, that's positive, but I also have this set up to work more like an oscillator. When we get above the green line, that means we're looking extreme positive, and maybe we're a little bit exhausted. But at the same time, if we get above this green line, that can suggest good momentum. Where this was most helpful is when we were just screaming to the downside. You see these highlighted areas here? Well, we haven't been weak enough, at least over the last couple of years, to really register anything along the way. I still like to look at this, but it's really not helping us right now, so I haven't been showing this chart. Then we look at those stocks above the 50-period moving average. Also use this like an oscillator where we get extreme positive or negative readings. Typically, when we're above 50, that's more positive. And I have another chart that also does the same thing, but I look at it in a little bit different way. But when we're above 50, like we are now, we're turning back more positive. Then I don't show this type of chart in the daily video. This is looking at the mid caps that are above their 50-day moving averages. This is improving, looking a little bit better. And then I also look at the small caps, which really started to come under weakness. They are showing signs of improvement, but we still use this like an oscillator when we get an extreme positive or negative reading, but we're not getting that right now. And then the last chart that we look at here, and we have to remember the context. We really started coming down with the 2-year yield. Now, that's usually positive for the S&P, and that can often give good support in the short and intermediate term. And you can see where that's happened before. Well, when we were coming down in the earlier part of August, it was because folks thought the economy was falling apart. And so that changed the context and was actually turning things negative instead of positive. Well, now we're starting to go back up a little bit, and the scenario is switching back over to looking more positive. So this declining could end up actually being positive. And as it has been declining, since we're looking a little more positive right now, this will often give good support to the S&P, at least in the short and intermediate term. So thank you. I really hope you found this helpful. I hope you're having a wonderful weekend, and I will talk to you in the next video.